Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Let's start off the Avenue podcast. I don't know what number or series this is, but hello, everybody. Paul, I like your background there, all the books in the background.
Yes, I'm a very studious person.
Well, studious indeed. We're here to talk about bonds, the economy, interest rates, GICs. We can talk about all of it, but
I think it's all things fixed income. I think that's what we're kind of talking about.
Okay, so let's talk about fixed income, the forgotten asset class, or the asset class that's being
detested at this point.
Yeah, exactly. So why don't I just start it off by, it's amazing how many clients ask me, why don't I just put my money in GICs? What's the point of investing in bonds with GIC rates pushing up around 5%, depending on the issuer? And what is the dynamic in the bond market currently? And I don't know. Let's just talk
that's
about
an open question. Yeah, we're struggling in the bond market. Obviously, we're taking the lead in regards to versus the stock market. We're taking the lead that inflation in the bond market is telling you that inflation is going to be longer than expected, higher than expected, and we're preparing for it by getting yields higher and listening to central banks that keep saying they're not done yet. They certainly will be slowing, and they'll most probably be stopping in the next, let's say, 3 to 4 months. But that whole idea of, the central bank will then start lowering rates by the fall this year is misleading. And in our opinion, it's generally not going to happen till at least mid-2024. There's this stickiness to inflation, and there's this hyper growth that's coming from full employment in both Canada and the U.S.
Yeah, sorry, I don't mean to interrupt, but it's amazing that the central bank has really kind of talked out of both sides of their mouth in previous meetings, where they've been very clear and will continue to raise rates until something breaks, and then they walk that back a little bit in Canada anyways.
Yeah, I think they were getting pushed or bullied by the street to relent and say, oh, this is just a temporary thing. Remember that term, transitory inflation? Well, that went out very quickly. After 6 months, we found out that it wasn't transitory. And so the trouble is the curve is incredibly inverted. And so let's explain that to our audience. Curve is generally positive in nature, meaning from 1 year to 30 years, you generally have a positive slope, meaning, 1 year bonds are, say, 2% and long bonds are 4%. And that gives you the positive. Well, in today's dynamic, we have short end rates, 2 years and under, at around 4, 4.25, 4.5 in Canada, and higher in the U.S. And the 10 years and 30 years are hovering around right now 3.25. So there's close to 100 basis point difference between 2s and 30s, which is
so the farther you go out, the less you get paid. So it's counterintuitive. In a normal yield curve environment, the farther you go out, the longer you lend money to a company, the higher the rate should be. Where it's the opposite now. So short rates are high, the long end of the curve has come in. And what is the bond market telling you? The bond market is telling you what?
Yeah, and that's the key, is that why is it this way? Is that the bond market is telling you from a recession risk standpoint, we're at the highest level, because the curve only inverts when you know that we're going to see a recession. And following that is you have the central bank starting to lower rates aggressively. And that's why you have the 10 and 30 years preparing for that. But we think as a firm that it's inappropriate to hold a very large position of 10s and 30s, just because the risk reward is not really in your favor. Because one, via inflation, you're not really earning a real rate of return. You're actually losing.
And if you're wrong, you get.
And if you're wrong, yes. And last year we found out if someone owned just long duration bonds, and I'm talking 30-year maturities, they were down close to 20%, if not 25%. So there's a real risk to the tail of the bond curve, 10s and 30s, where it could just wildly move out. And we're not saying that it's going to happen, but the risk return is really not in your favor by stepping in the water yet. Go ahead.
We're talking with too much jargon. Let's step back for a second. So the farther you go out, the lower coupon payment or lower interest rate. So the bond market's telling you we're going into recession at some point. Central banks will have to pivot and rates will have to come back down. But if you take that view and you're wrong, you can really get hurt in a portfolio by going out too far.
Right. And that's what I was saying, is that just right now, it's not a good bet, because generally over the midterm, when I say midterm, it's probably over the next 2-3 years, we definitely not only will, one, have a recession, but two, inflation will come down, and three, the central banks will lower aggressively if they can. You look at a lot of stuff and you talk to a lot of clients, and our biggest competition in a sense is the GIC, and a lot of clients are calling and say, well, why don't I just own a GIC instead of owning bond product or bond portfolio?
Let's dissect that. Yeah. So let's say, I don't know what today's yield is on our bond portfolios, bouncing around, call it anywhere from 4.2 to 4.7 over a 4-week period. But the client's saying, why don't I just buy a GIC and get 4.9 or 5? And the answer is, one, if you're locking in with a GIC, you have no liquidity. In this environment, I think you place a premium on liquidity, or being able to get your money out of the investment, especially if something changes, whether rates go down, inflation continues to roar ahead. Number two, if you saw a GIC, market to market, which you don't in the account, you would see the volatility in the GIC market as well. But really, the big thing here is not only the liquidity, but if rates roll over at some point, you have the opportunity to make capital gains within the bond market. And if 12 months out or 2 years out, if rates are lower than they are today, well, then guess what? Now you have to buy a GIC at a lower rate. So over longer periods of time, the bond market will outperform the GIC market. If you look back a year and a half ago, 2-3 years ago, there was a point in time where you were getting sub 1% on a GIC.
Right.
Anyways, that was a mouthful.
And then there's liquidity issues too. You remember the obvious thing is the GICs, you're generally locked in for a foreseeable amount of time. And in a bond portfolio, it's fluid. There's a lot of maturities and a lot of liquidity. So you have a little more flexibility. And just like you said, you have more chance of capital gains, and for that matter, capital losses. But the GIC doesn't recognize it because it doesn't show you the opportunity cost 2 years in when rates go higher by 2 or 3 percentage points. You locked in for 5 years at 2%. Well, you're still locked in. So there is this opportunity cost that you're losing that you don't really see or recognize. You just accept.
And then if you're maturing bonds too, right? So if you have a large portion or even a smaller portion of your portfolio that's maturing in a year or two, if rates do go higher, that's not a bad scenario either, where you see maybe a paper type loss, but you mature the bond, you get your principal back, and you can reinvest it at higher rates.
Well, they always talk about laddered approach. So if you owned a GIC, it'd be better to own GIC ladder. But in the sense, what we do is we have a smattering of maturities. And the other thing is we're not beheld by one bank or by one credit. We're appropriately diversified in our bond portfolio with many credits, because we don't want to overexposure, even though most of these credits we own, and for that matter, GICs that are issued, they're all high quality pieces of paper that you don't have to worry about. There still is that moment in time where you go, I have $1 million GIC at one bank, and there is a credit issue there.
Well, that leads me into my next question or discussion point. I mean, in looking at the high yield market in our investment meetings, it's still, in my view anyways, it doesn't seem like the risk reward is still really in your favor to stick your neck out at this point in time.
Yeah, that's an interesting point. So it's a weird situation. So from an absolute level, you can get high yields at probably, let's say 7-8%. That's pretty good. But at a relative level, meaning the difference between, say, risk-free, which is government of Canada, rates and yields, versus high yields, which is a junk bond, it's only about 2 percentage points or 250, 2.5% difference. And normally, historically, we usually see about 4% difference. So from a relative perspective, Avenue's position is that for a couple of reasons, we're very defensive in that spot because one, we don't necessarily think that rates are finished going up, so that's a negative to all bonds and especially high yield. Two, we think with this upcoming recession, the one thing we haven't seen is a liquidity crunch in the high yield market. And this is probably the biggest fear I have is if you have, like, for instance, a stock market readjustment or a stock market that goes down by, more than 10, 15, 20%, that impacts the high yield bond market because it is a quasi equity kind of proxy.
So if you're reaching for yield to try to get a few extra percent by buying a junk bond or a non-investment grade bond, is probably not worth the risk, especially since you haven't had a credit event yet. And what's amazing to me is I was just looking through this the other day, that the historical default rates on credit are about 4%, but over the last decade that has fallen to 2% because you've been in this low rate environment, and that's created a lot of these zombie companies. So you haven't had a credit event, and you forced people to go up the risk curve into private assets or private debt.
And that's what we'll talk about in a minute. But that's actually a really good point. The absolute level I'm not unhappy with. That's a generally good yield, but it's just the risk reward is still not in your favor because just as you mentioned, if we're going in a recession, if governments are highly indebted, if the consumer is highly indebted, at one point, there's going to be a stress point to the high yield market because also there was so much issuance of high yield debt 2 years ago when rates were, let's quote unquote, free, and they were only being issued at maybe 5%, a high yield bond. They're all going to be rolling over, and the companies are going to have to reissue and deal with 10% interest rates on their lending. So the credit quality is going to deteriorate not only from that they have to pay more interest expense, but just the whole group and the whole class gets very affected by a recession, and that's where debt defaults come in play.
Well, that's what scares me about the private credit markets or the high yield market.
Yeah, why don't you talk a little bit about the private markets, because it's always in our face. We always hear about it. You can also talk a little bit about the mortgage market, which is kind of slightly connected to the private.
I think everyone knows how I feel about private assets or these private funds, which are arbitrarily valued either once a quarter or once a year, and it leaves a lot to be desired. And you just have absolutely no liquidity, and the issuers have the right to freeze redemptions. It's kind of like saying I own TransCanada in my portfolio and it trades at this, but if TransCanada was private, it's worth $80. But to me, that's a bogus argument, because if you need liquidity or have to sell it on the open market, it masks the real price of assets if you had to sell them. This whole move over the last decade into just enormous amounts of money going into the private debt space. I mean, you have no transparency whatsoever. You have no liquidity, and
I'll give you another one. You have no transparency, but are you the investor who invested in that private fund? Are you looking at the trust indentures or the covenants of the bond? Like, are you what position are you? So no one is. So you have to kind of be an expert. I'm even like, I consider myself quote expert in credit, and I'm even would be overwhelmed by like a private issuance and trying to figure out do I get my money back in a liquidity crisis?
Yeah, so you're operating in an opaque market. There's a liquidity crisis, and what happens now? You're blowing the lid off of interest rates, and if interest rates go to 6 or 8%, and a lot
of companies there's a chance.
They absolutely could. And then if you have to roll your debt in a year or two, then what happens? Well, that is your credit event, right?
There you go. Well, that's why we're kind of preparing why we're not that aggressive in the high yield market, and we're more focused on the investment grade market.
Yeah. So although clients kind of have to suffer through this paper sort of decline, what they don't see is that you're maturing these bonds, you're getting your money back, you're reinvesting at higher rates. We haven't gone as far out or haven't gone up the risk curve. And if rates continue to go up, well, guess what? We'll reinvest the money and ladder them out. And we're not going out buying private debt. We're not sticking our neck
No,
out
so maybe I
into
could
the
talk
high yield
about our
market.
strategy for this year.
Yeah.
After the year closed, we kind of thought it out and realized we had a pretty solid position of 10. We were hiding in government bonds because of what happened last year, and it worked to a certain extent. But then at the same time, we had long duration. We had 10 years, a lot of 10 years, a little bit of 30 years. And in the first couple of weeks of January, we kind of realized that the biggest vulnerability is the spike in interest rates in the long end. So we very quickly lowered our duration or our maturity of the portfolio down from what was, if you use duration as a term, which is another way of saying how long is your cash, your maturity. Basically, we took it from 8 years and we're now down to 4 years. So we cut it in half. And really the focus that we really feel is a great opportunity is to buy 2-year investment grade bonds that you get the benefit of the higher yield curve, because remember, we talked about the curve being inverted. So 2-year bonds are roughly, Government of Canada 2-year bonds are roughly around 4%. And we get a added rate of return from the investment grade bonds that adds spread to it. So overall, we're getting roughly about a 5% yield on some of these bonds. And if I mention these bonds, they're pretty much household names like TELUS, Couche-Tard.
So you're buying it. You're buying companies with good credit ratings.
Yeah.
You're not going too far out.
Yeah.
If interest rates continue to go up, you can.
We're not that hurt.
Yeah, you're not that hurt, and you can mature those bonds and reinvest. And I think investors forget, because it's been so long, if going through other periods of inflation or higher rates in the stock market, the bond market has done okay because you're able to reinvest all the way through at higher rates.
It doesn't feel like that because the last 2 years have been losses, but first of all, there's small losses relative to the equity market, but it's still kind of, as you mentioned, it's as much as it's real, it's still kind of paper mark to market because you're not selling the bonds really, you're maturing them. So like a GSE that's not priced, all these bonds get priced every day, so you feel the effect, the positive and the negative of it. But remember, in the bond market, you're not dealing with huge variance of pricing.
Tell the audience, when you do make a change in the portfolio or we're active in the bond portfolio, if you're maturing bonds, why are you then at some point, why will you make a trade, or what are you trying to accomplish when you sell a bond in the open market and buy something else?
Well, there's several strategies that, or opinions that we have. Like, for instance, come January, we basically sold all our long bonds and our 10-year bonds to deploy where we're waiting for spreads to move out and interest rates to go up. We were waiting for the moments where we thought that the 2-year was a really good place to almost hide in the bond market, and at the same time, you're getting a really decent rate of return. And it allows you, like you said, to redeploy. Our strategy generally is buy and hold. When how we do this is we buy a 2 to 5 year credit, we get our nice coupon, and then it rolls down the curve, and then it goes down to a 6-month piece or a 1-month credit, and then we sell it or mature it and then reinvest the same thing and just keep doing that for the most part.
So when we're making a decision, you're right. We're there to buy and hold mature bonds, ladder them out. But when you want exposure, more interest rate sensitivity, you can make a move to buy a longer dated bond, or the opposite. What we've done recently has gone, shorter duration and made a move. Or if we can improve the credit quality or any of these things, we will be active. I don't want to mislead our audience and say it's a buy and hold strategy.
No, we are active. And we also made, we should say this, and we've said this in our letters and in our past quarters. For the past 2 years, we've owned inflation index bonds, which have helped us protect ourselves against inflation.
What's your view on that, just in terms of the Canadian government kiboshing the whole inflation protecting us?
They had liquidity. I guess the whole market is up in arms with the Bank of Canada and the federal government saying, at this moment in time, when there's inflation all over the place, you're not going to issue inflation index bonds. So that tells me either two things. One, that there is a real liquidity issue and no one really buys these bonds because they're complicated. Or two, the government doesn't want to play the government doesn't want to pay inflation index bond prices like yields, because if you're paying 6 or 7% in inflation, you're basically getting that in your bond. And so it's confounding why they would issue that they would stop issuing it. I actually don't even have an answer to that question. I still don't know why they would do that. And we might not ever know.
Well, you know what they say about bond managers? They say bond managers are a little out there, and you have to be a bit kooky to want to study interest rates and credits to this level. It's almost like being a drummer in a band or a hockey player. You need to have a certain mindset. So,
just try reading The History of Interest Rates. That's a real riveting book. I read that, and that'll put me to sleep all the time.
We have Bryden for the financial history lessons.
Yeah. But anyway, and then maybe I can throw the last subject, and I can throw this back to you, is, the worth of bonds, the asset allocation aspect of the bonds, because we both of us talk to clients all day long. And I wanted to see what's your view on just, the asset allocation, which we always struggle with over the last year or so.
Well, first of all, there's no understanding of the bond market for the most part. Even understanding the difference between an unsecured bond or a secured bond, or high yield or not high yield, or how far you go out, or the ability to produce capital gains. There's a lot of confusion in general, but really, from an asset allocation point of view, it's a stabilizer of your portfolio. Historically, bonds have been less volatile than stocks. The largest percentage of the interest rate move is already done, where interest rates have gone from 25 basis points to where they are today, which I think is almost a 1,600% increase, which is kind of crazy. So, I mean, the majority or a large part of the downside, I would argue, is already passed. And if you need liquidity, or you need money out of your portfolio, or you're retired, or you need a consistent income stream, it just helps damper the volatility and provide some liquidity, because the last thing you want to do is sell your stock portfolio. If the market's down 20 or 30%, heaven forbid, and you call up Paul Gardner and say, I need $100,000 to live my life this year, you've just hurt them by having to sell assets on the low. So it acts as a stabilizer. Retired clients, or clients where it doesn't suit their risk profile, need money outside the stock market, and a good vehicle for that is bonds.
And most importantly, Matt, as much as we are getting pushback the last 18 months or 2 years, we actually have a yield now in the bond market. So although real rates are negative, to sit out and hide out in the bond market, and in the way our portfolio is structured, and get 4.5% or 4.7%, and an opportunity for capital gains if rates roll over and you go into a recession, I mean, it's not bad. And if you need liquidity, stocks don't really provide that if you're in a downturn. It's almost turned into also cash is not really an alternative right now, because cash now is, you're losing roughly about 5 to 6% a year on cash, whereas at least in the bond market, you can make the case you're flat or losing 1%. When you adjust for inflation, I'm talking about, obviously.
Oh, absolutely. What else do you want to talk about? I don't know. I'm running out of steam here. I was not
other than being excited about the Raps. Hopefully Raptors can make a run. That's about all I got.
Well, I think we started off this podcast slow, but we finished strong. I think we covered a variety of topics, and as always, we're just ourselves. We're not scripted, and anyone has any questions, feel free to reach out.
Thank you. Thanks,
right.
Matt.
Take care.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.